I'm going to be talking about the Dodd-Frank Act. I'm your last presenter of the day, so hang in with me. We're in the ending stretches. Who's here heard about the Dodd-Frank Act? All right. All the lost ones. I didn't know about it until I got into an internship at a housing authority. So it's one of those laws that is kind of undercover. So I'm just going to get into the basics. What is it? It is a comprehensive reform of the banking industry, and it was named after the two legislators who created it. You've got Chris Dodd up top and Barney Frank below. And its purpose is to regulate the financial markets and make sure that the financial crisis of 2008 never happens again. It's been almost 5 years since the Great Recession, and we've made progress, but we still got a long way to go. So Dodd-Frank is very reflective of that. It is about a 2,500-page document, and it contains more than 400 rules, 250 of which have been defined. So there's still a lot of uncertainty with it. There's still a lot of work to be done, and we're just going to see how it turns out. This is the new governance under Dodd-Frank. Clear as mud, right? I didn't put this up here for you to understand anything or to give you a better understanding of it, just to let you know this is what's happening with Dodd-Frank. All I want you to take away from this is the green boxes represent the agencies that were created from Dodd-Frank, and the blue boxes represent the agencies that were established before Dodd-Frank, but now have new powers through Dodd-Frank. So there's a lot of activity here, and Dodd-Frank is definitely shaking up the regulatory scheme.
When did this go into effect?
2010. So yes, it is fairly new. So where did this reform come from? I want to do a little history because my mom always told me you can't know where you're going unless you know where you've been. And there's a lot of, the structure of Dodd-Frank is really dependent on the reform that we've had in the past. So who here, well, none of us remember it, but who here knows about the stock market crash in 1929? What happened was, before 1933, banks were allowed to invest depositors' money. So that people would put their money in the bank, and the bank would invest it into stocks. And for a while that worked. It was a great way to create capital and to make money. And then the stock markets crashed, and the banks were out of money. So when people went to go get the $100 that they put in the bank was like, we don't have it. So what happened was Congress acted and created the Banking Reform Act. And what it did was say banks can no longer invest depositors' funds. And it made sure that all funds that are deposited into banks are insured by the federal government. So that's the FDIC. Then, and that was what it was. After 1933, banks either were investing stocks and bonds, or they were commercial banks that just dealt with checking accounts and savings accounts. Then in 1980, the commercial banks said, these restrictions are too much, we're too small, we can't compete on a global basis, we can't compete with the investment firms, we need to be able to invest. They finally got their wish in 1999, the law was repealed, and they were allowed to invest depositors' funds again. And then they grew. They were able to raise their capital, able to make money, able to grow. How big did they get? So this gives you an idea. This was basically the biggest players in the market in 2007. So this was before the Great Recession in 2008. As you can see, the commercial banks, Chase, Citigroup, Bank of America, are much bigger than the investment banks. The investment banks are pink boxes. So they were saying we need to compete. However, they got 3-4 times as big as the investment banks, investment firms. I also want to point your attention to this orange box at the top. That's American International Group, also known as AIG. And they got this big because they were set up as a safety net for the commercial banks. So then the Congress acted again because obviously that business model didn't work for the banks. And they said, we need to limit this the ability of the banks to invest. So now we have Dodd-Frank. And it's a huge document, like I said, and there's a lot in there that pertains specifically to the financial institutions. However, there are some things in there for consumers, so I'm going to focus on that. One of the things that it does is prohibits the banks from investing depositor funds. They can't do it for their profit. They can only do it for your profit. The banks they've expressed that it's going to be a little difficult to figure out whose money is whose. So Dodd-Frank gives them 7 years until it gave them 7 years at the time. 7 years to divest those funds. And anything that is over 3% goes back to the depositors. It also oversees the insurance companies like AIG, who were supposed to be the safety net for the risky investments and activity that these banks were getting involved in, and to make sure that they're not taking those risks and really making sure that it doesn't happen again, and so that they can provide real security to the commercial banks. And then it created the CFPB, the Consumer Financial Protection Bureau. The CFPB is the enforcement body of Dodd-Frank, so it does all the heavy lifting for Dodd-Frank. And it is funded by the U.S. Treasury, not governed is the wrong word. The U.S. Treasury doesn't really have any say as to what the CFPB can and cannot do. And the CFPB is definitely a resource for all consumers. However, it does focus on students, older Americans, service members, and veterans, because they've been recognized that there's some special abuses that happen with those certain demographics. And it focuses on financial products and services, specifically student loans, mortgage loans, credit, and other consumer loans that we've touched on a lot today. Student loans. So we've covered a lot of financial products, a lot of consumer loans. We haven't talked about student loans. And it's really important that we cover it because this is the next debt bubble that is predicted or feared to burst and cause another financial crisis. The reason being, there is more than $1 trillion in outstanding student loans, and the burden is carried by more than 38 million borrowers. And since 2008, the amount of borrowing has really jumped. It's really increased, and the delinquent rate of those loans has also increased. So again, people are having troubles paying these debts, and they're huge. So this is definitely a big portion of the financial market that could cause a really big problem if they fall through. So the CFPB currently is regulating private student loans. Reason being that private student loans tend to have higher interest rates and variable interest rates, so they're a little harder to predict as far as repayment, and then they tend to be a little less flexible with repayment options and alternatives. Now, how many of us have private student loans? I don't have any, and I have several student loans. And as you might predict, they make up a very small portion of the student loan market, 15%. And the CFPB has been criticized for having such a narrow scope of this portion of the financial market. So I just wanted to mention that 2 days ago, on March 14th, the CFPB proposed a rule to regulate non-bank companies that service more than 1 million student loans, and that's going to impact companies like, it will impact 7 companies that currently hold about 49 million student loans, service 49 million student loans, and that would make up about 70% of the market. So that would give them a larger regulatory scope on the student loans. And there's special attention paid to Sallie Mae because they are a very large servicer of these student loans. And it's not clear yet how they're going to be regulated, because CFPB is allowed to regulate any financial institutions that have more than $10 billion in financial assets, I guess that's the word I want to use, have more than $10 billion in servicing of debt. And while Sallie Mae has like more than $200 billion in student loans that they service. They are a non-banking institution. So if they are going to regulate them, it's a question of whether they're going to regulate them as a banking institution or a non-banking institution, whether they're, it's $234 million. So they don't quite meet that threshold for banks that are more than $10 billion.
And what's really cool, Adria also has some really great commentary under that, under myconsumertips.info, in looking at this issue, because it is a really growing and important concern about student loans. They're showing their statistics now. People are, it's actually affecting people. They're trying to retire. People who are now retiring and still have student debt. Yeah. And as we've discussed, it's not just chargeable or bankruptcy, and these are things that really can follow people for the rest of their lives. And student debt is actually a really big issue. A big issue for us, as educators, and for students, and for parents, and thinking about school and how you're going to deal with any sort of education.
That's interesting that was brought up, because I had a friend who just thinking that she might need to be paid. And so she has one private school loan that she was told that can be dischargeable under BP because it's private.
See, I'd want to check that with an attorney, and I'm going to have to defer to an attorney on that, because I would have to look at the terms and conditions of the particular loan. But
she just mentioned it the other day, and I thought that's how ironic.
Yeah, it's something to be careful about, and it's another one that can affect your credit. If, let's say, you have a private loan and then you don't make payments on it, and then, it can cause a lot of difficulties for an individual throughout their lifetime and carrying a lot of student debt.
Professor Schmitz, the new amendments made it so that it's harder to discharge. They expanded the definition of school loan so that it includes any loan that was used to get schooling. So it's not just the government loans.
I will tell her.
Thank you. That was awesome, Jen. Thank you.
Yeah, one of the things I did blog about this on Consumer Tips, and they're seeing a correlation with young people that are under 34 not borrowing for auto loans, not buying homes. That's really dropped for people in my age group, and it's because we have this burden of paying back our debt, we can't really participate in any other aspect of the economy. So it's definitely something that reaches to a lot of different aspects of the economy. Okay, so this consumerfinance.gov website is the CFPB website. Great resource. Definitely check it out for any time that you're thinking about borrowing. And they have know before you owe documents. This is the financial aid shopping sheet. And they create these for the mortgage loans, the student loans, the credit cards, and they're just really their data sheets to show you everything up front, easy to read, and get the most important information. What I love about it is, like, you can see the default rate over here. The green and red bar shows you that this sample institution, this is not a real institution, but they're somewhere in the yellow, and that's something to be aware of. It shows you how their tuition compares to like the national tuition or private school tuition, so you can see how it compares. In that aspect, what I really love about it, and it's kind of fuzzy, so you may not be able to see it. This shows you like how the tuition would break down for the specific institution. This shows you the financial assistance, and this here is after graduation, how much would you owe? Like this. After everything has been calculated, it actually will give you an estimate, and it says like $708 monthly if you go to this institution and have all that assistance there. So for me, that's the bottom line. How much do I owe when I graduate? How much are my payments going to be? If I had known that for the 10 plus law schools that I applied to, it probably would have made all the difference. So that's a great resource. And over 500 colleges and universities have agreed to use this. So if anybody's looking into any programs, ask for it. Mortgage loans. So there's a couple, three major requirements that have come from the CFPB on mortgage origination. And there's more, but these are the major things. Ability to repay. Lenders can now no longer lend to Lend to borrowers, if that mortgage loan is going to be greater than 43% of their pre-tax income. There's limits on prepayment penalties and no more dual tracking. Dual tracking is when a borrower goes into default or is having issues paying their mortgage, they would apply for loss mitigation or loan modification, some program, and the servicer would start the foreclosure process. So it created like this conflict of interest because they're both trying to help you cure the default and also trying to take your home. So the CFPB has said no more of that. They have to be, if they've applied to a program and they're waiting and it's in review, the servicer cannot start foreclosure proceedings until they've heard back from those programs, and they have to be 120 days in default.
When did that go into play? Was that 2010?
I think it was January of this year.
Of this
It's
year?
when they
Of this
issued
year,
the
yeah.
law.
I
A lot
have a
of
friend that
these-
got caught in that exact situation when the Arizona market crashed, and it was horrific.
Yeah. And, it's one of those things where borrowers were like, I thought, you were helping me, and
Yeah.
doing
And
the
that's
opposite.
something that's great to point out as, that a lot of these things have come into effect. Like the law passes, but then it's not immediate, and.
Something has to happen for the law to be created in the first place.
And then we have to get it right, and as, and this is, I'm so happy, like, Andrea's, and it was funny, because, like, having to be last is hard, but at the same time, thank you, because it's kind of this is the future, because a lot of these things are coming down the pike, and the truth of the matter is that the CFPB is right now creating regulations that they're just proposing, and they're actually asking for public comment on a lot of these.
Yeah, I saw that.
Yeah, so like, let's say you want to say something about it, this is how you get that opportunity to do it.
I mean, like all of us that were in school, like we're having to think about, that's $708 payment for our school. That means that's one less kid we could possibly have, or like,
Well,
can we afford a house payment?
I can't tell you how
It's real.
often people decide, well, we can't get married yet because I still want student debt, right?
Yeah.
And things, that's very real. You have a great, she has a great blog about that.
Well, what's the recommendations on what they have over the selling of the loans? Has there any development on those regulations and so forth? Selling
That's
off the loans?
horrible, by the way. If you default and they sell your loans and then they tack on like $7,000 and you've got all this compounded interest and the fluctuating interest rate, you don't even know that you are talking to the right people.
Right. And it's later.
I know that there's definitely activity on it. I'm not sure of the specifics. on it,
And
but I
the
know
mortgage
CCP is aware.
servicer, and Marcia can maybe speak to it, but there's a lot of, and I know that they're tracking it here at Boulder County, things like that, but there's like different like settlements and about the mortgage servicers.
Yeah, and I'll just comment quickly because that dual tracking has been horrific. And if any of you have heard of the national mortgage settlement, that came about because all the Attorney General's offices in the United States had gotten enough complaints regarding the horrific treatment that they were receiving from all of the 5 major lenders. So it's not even, or lenders and or servicers. So it's not even all the servicers out there, and there are still servicers who continue horrific behavior, and I'm hoping now that there's a way to complain about the ones not covered under the national mortgage settlement, that they can't do this, because it would be horrible. You go through so much work and try to get a loan modification, and meanwhile the lender would just continue with the foreclosure process. And we even still have people coming in who signed loan modification documents and thought they were all set, and then their home went to foreclosure and the auction happened and they were evicted. So it's terrible behavior.
It
So this
really
is
is.
fantastic.
And thank you, and Marcia, and following up on that, 'cause it's funny because I had Countrywide. Do you guys remember Countrywide Financial? They were the original mortgage servicer on mine, and then Bank of America bought them out, and then good luck is all I have to say.
Bank of America, I mean, that
Goodness,
it's like
I've
a
got
swear
nothing nice
word.
to
It's,
say
you,
about-
I mean, you can't even,
Oh, man.
you can't say it in any circle anywhere and without.
And they cover other consumer products and services. The fringe lending, which one of those, an example of that would have been the payday lending that we talked about today. We talked about the CARD Act and how the CFPB is over that. And then there's Project Catalyst, which is a program where employees of the CFPB are going out to a lot of financial institutions and other companies that offer financial products and services and saying, having direct conversations with them on how to incentivize them to create more consumer-friendly, understandable, easy-to-read services and products. And consumerfinance.gov, once again, this is a great resource to get questions answered, to see about the regulatory updates, especially those rules on the mortgage originations that you guys are interested in, tips on borrowing in any aspect, mortgage, credit, student loans. There's a lot of resources here, and submitting complaints. The complaint database Hunter had touched on, talked a lot about actually, and I just want to say that the database is searchable as well. So if you're interested in seeing how many, what is the most complaints in like credit cards, or if you're interested in seeing what your neighborhood complains most about, if you're wanting to see like who's got the most complaints out of the mortgage servicers, you can search all of that information. And as far as submitting a complaint, telephone, email, mail, through the website, fax, and if you call them, they accommodate more than 180 languages, including hearing and speech impaired. So it really is very accessible for all consumers. Anything else? All right, thank you.